Okay, looks like you made it. You went through the entire 10 episodes of Series 1, you did all the unlearning required to unwind the damage done to you by years of dwelling on retail trading beliefs, and here you are. Despite the mountain of work that you now know is ahead of you, you still decided to go ahead and do it. More power to you. So to get you started on your journey, today, as someone who's been neck deep in this field for over 15 years, I'm going to share with you some precious hands-on insights beyond the tired industry cliches about the true nature of quantitative trading, its scientific DNA, the key misconceptions that afflict it, and why when done right, it can be far superior to any other method of investing. So buckle up, because here starts our Series 2. The buzzwords are strong with this one. Algorithms, artificial intelligence, neural networks, latency arbitrage, work-forward testing, Monte Carlo simulation, and what have you. Chances are that every aspiring trader has already come across these fancy terms at least once when looking at the quantitative side of the trading industry. Despite its increasing fame with the mainstream introduction of high-powered technology in our households, this specific branch of investing still remains largely misunderstood by most, not least retail traders, and most notably so when it comes to its proper scientific implementation. For the purpose of the following demonstration, we'll set aside the entire HFT industry, which, for certainly being quantitative by nature, is much more akin to an IT and technological challenge in exploiting inefficiencies within the microstructure of those exchanges information systems than it is about truly modeling price formation as a whole. So as always, let's try for starters to tackle the semantics and define what exactly we're talking about when mentioning the words algorithmic, quantitative, or systematic to qualify this trading style. A broad yet accurate definition is a numerical data-centric type of investment analysis that makes use of a finite, quantifiable, and unambiguous set of condition-based rules which output can be tested, executed, and replicated uniformly to initiate buy and sell decisions. Sounds like a mouthful, right? But beyond that definition, one aspect should not be overlooked. You see, understanding that quantitative trading should inherently imply a probative cost-consequence relationship within a given sequence of rules is absolutely central to what is going to follow. In too many instances, and increasingly so with the rise of computing power, this very consequential relationship that seemingly persists at the operational level within an algorithmic code is all too often completely lost at the mathematical level in the reflection that precedes the code. Most codes nowadays have long broken apart from the underlying reality that they should logically condense, describe, explain, and to some degree predict. Quantitative trading has in this way mostly morphed into a mere exercise in data mining and has become perverted from its initial scientific legitimacy. In short, it was dumbed down and rendered mostly useless by the greater part of a trading industry that became too drunk on technology to yearn for actual research that reaches beyond blindly crunching data. Traditionally, reading the news, issuing DCF-based papers, analyst views, and other types of subjective investment opinion pieces all rely on the natural brain's tendency to draw patterns out of numbers or events and create impressions which then result into forming opinions with or without consequential relevance. In stark contrast, the initial promise of quantitative trading was to bring scientific consequential order to this chaos in order to break away from those antiquated and unreliable ways. Quantitative work was never meant to reintroduce subjectivism by merely reordering it into a mechanical form. Yet, here we are. Whether that applies to seasoned professionals as much as those hopeful retail investors out there, that very reasoning is why quantitative trading has turned into a dead end and a delusional intellectual trap for most. By becoming a grand exercise in systematically rearranging nonsensical statistical artifacts, it is therefore no surprise that few are able to survive anymore at a quantitative game that rarely bears the promised fruit of robust, surviving, and long-term performance. Had the industry been faithful to the origins of this type of analysis, the present outcome should have been avoided. As an all-encompassing science, systematic trading offers this unique opportunity to leave both its inputs, meaning its logic, out for investigation, and its output, meaning its performance, out for measuring and ranking. So why are most traders struggling with reliability? Is it because, as I hear it too often, one cannot capture the complexity of the market within a single formula? Think about it. Reality is complex, of course, and may be too complex indeed to describe exhaustively with a mere model when taken in its entirety. But at the very least, is it really such an impossible endeavor to condense into a handful of drivers that explain most of it? Actually, maybe not. The consequential relationship between logic and performance cannot and should not be dissociated if you want your model to make sense. And when I'm talking about making sense, what I mean here is making sense from a mathematical standpoint, not just from a statistical one. At the backtest level, performance should not only be generated by the logic of the code, it should also and especially be explained by the behavior and the cross-relationship of the data that it tries to scan for, identify, and exploit. As we'll see it in further detail down in Series 2, this assertion is viscerally essential as to how proper quantitative trading should be conducted. Failing to understand that aspect is precisely what is drawing quantitative professionals to an inevitable failure through eroding performance over time. Or conversely, what is leading retail traders to rely on indicators and optimization as the weak basis for designing their systems. No matter the level of sophistication of the trader though, the flawed common denominator of a belief remains, which is that performance is only contextual, that stochastic processes cannot be described by a holistic framework, and that, in a nutshell, since quote-unquote truth cannot be known, all strategies are doomed to eventually fail anyway because, wait for it, markets somehow change over time. Does it sound like a familiar statement already heard ad nauseum? The root cause of this delusion and the ongoing demise of quantitative performance can be attributed to a peculiar trend, which is the rampant departure from theoretical mathematics to the benefit of an over-reliance on technological applications as the basis for algorithmic development. By being obsessively focused on an arms race for ever greater computing power, and because of a tunnel vision that promotes coding before thinking, the quantitative trading industry has come to prioritize computer scientists over abstract thinkers in an uninspired shoot first, ask questions later pseudoscientific culture. But this culture of brute force development bears the cost of its own limitations, however. And the cost of successively uncovering nothing more than fleeting correlations, as opposed to researching perpetual causations, is that of scientific doubt, ballooning operational expenses, profit margin reduction, and especially lackluster trading performance. On one hand, professionals are setting themselves up for a literal life sentence as a fund, a trader, or a scientist to make endless iterations of the same aimless time and capital investments. Think of it as running behind your own tail to mend unfixable inefficiencies, and you'll get the idea. As for retail, the picture is not better. The symptom invariably cascades into an obsession for the fanciest indicators, the frantic churning of backtests, and those heavily parametric walk-forward optimizations until the test results are perfectly curve fit to history. In short, throw everything at the wall and see what sticks is the retail culture of quantitative trading. And if nothing does, statistically redraw the target around the dots to make it look like you hit the bullseye. The more the merrier. But does anyone understand why they should use such or such indicator from a mathematical standpoint? No, of course not. Because just like in the so-called professional field, mathematical comprehension of price motion dynamics is not ever given an afterthought. Whether you look across the entire spectrum of the algorithmic field, causation is almost always systematically set out of the equation. Cop-out techniques vary in color and flavor between pros and retail, of course, but mostly as a function of financial means. The desperation, though, is similar. While pros will keep throwing large amounts of capital at their aimless endeavor until they have to shut down after a rogue drawdown, retail almost invariably ends up falling back to martingales and other money management tricks until they go bust, that is. If retail can be given the benefit of the doubt for being de facto novices, the sad part here is the travesty of science that reinforces itself in the self-labeled professional world. As peer reviews of licensed professionals who share the same biases congregate to validate so-called innovative techniques that are grounded in those exact same biases, is this any wonder then that we have been witnessing an absurd proliferation of fancy new methods of analysis that were supposedly going to revolutionize the industry, only to crash out miserably a few years later? Talk about neural networks, artificial intelligence, pattern recognition, machine learning, news release snooping, data mining for social media trends, and now the latest snake oil, quantimentals. How many times have I been told that I was going to be put out of business, that my systems would suddenly stop working, etc.? And yet, here I am at an all-time high after 15 years, with nothing but a notepad to write down my math, and a decent computer to write my few lines of codes and run my scripts every day. So what gives? Could it be because none of these techniques were ever going to address the mathematical underpinnings of the motion dynamics of those assets that they intend to trade? Could it be because none of these new, supposedly groundbreaking methods were ever going to deal with causation? Or could it be that the solution of modeling price is in fact to be consequentially found within price itself, and not within some remote correlation with extrinsic foreign data inputs, such as fundamentals, for example? If I were wrong, shouldn't it be broke by now? One thing's for sure, if quantitative trading is indeed more about math than it is about computing power and coding, a lot of those dire flaws that continue to plague quantitative trading can suddenly be fixed, not least of which being the recurring issue of decaying performance and the classic questions such as, should I keep re-optimizing my systems on a regular basis? When should I deem a trading system broken and stop trading it entirely? Or how can I tell a statistical artifact found through data mining from a consequential, physics-based relationship found through math? Solving these questions are not only the key to reclaiming those systematic trading promises of reliable performance, it is also the most important gateway to unlock the full spectrum of those perks that should come along with the proper implementation of that science. When done right, quantitative trading should go beyond the execution discipline and consistency that a rule-based method can offer. By focusing on the very causation of outcomes in prices, quantitative trading can bring back solutions as relates to the following 4 key characteristics. Number 1, versatility. Equipped with an underlying logic that understands the specific price motion of each asset class, parts of trading systems can seamlessly be tweaked, transposed, and scaled to the next asset class, thereby reducing both the development time and budget required to do so. Number 2, robustness. Understanding price motion dynamics allows to focus on a limited number of drivers and inputs. By boiling down the required degrees of freedom to a minimum in a system, it increases straightforwardness in the maintenance, the execution, and especially the robustness of algorithmic relevance over time. Number 3, predictability. Using a causation-centric architecture as opposed to weak past correlations enables for backtested simulations that keep the future universe of outcomes much tighter around their historical mean. More refined risk assumptions dramatically increase the accuracy of operational decisions in terms of position sizing, cost impact on execution precision, and replication quality versus those expected theoretical results. And number 4, business proof. From a plain business standpoint, proper quantitative modeling also offers a luxury that any professional in the asset management industry will have to appreciate, which is that of an improved management of client expectations. The reliability obtained from a rigorous development process leads to performance reliability, which itself converts into much improved client satisfaction. Being able to quantify return and risk precisely is paramount when truly maximizing the fulfillment of one's fiduciary duty, meaning not through some disclaimer regulation that only theoretically reassures about fiduciary concerns, but through a proven operational process that actually solves that issue in real life and effect. As you can see, quantitative trading is most likely not exactly what you thought it was until now. Something is off indeed in the way most are implementing it, and performance shows. The lack of mathematical causation is without a doubt the number one cause explaining why you are not today where you intended to get when you started writing your first algorithm. As we move forward with this series, we will see that doing it right is not that complicated, but it demands to be very rigorous and especially intellectually honest with ourselves as to what it is that we are actually achieving when using such and such quantitative tools. Our step-by-step tutorial will be starting from the very next episode, so take time to digest this introduction, and I'll see you there, traders. Stay sharp.